Okay, this is Luke Appel. I'm going to be presenting our stock portfolio. So we invested all of our money right off the bat. So we split it up to $40,000 per company that we were going to invest, and we'd fully invested right away. So these are our number of shares purchased, and this was the share price that we bought them at. I think we did a very good job of diversifying our portfolio. We are in tech, video games, real estate, retail, manufacturing, car and automotive, and consumer goods. Um, so as you can see here, we're down a total of $66,092.48, which translates to 6.6%. So given the circumstances, I think we were doing pretty well. So just a couple of companies that are worth noting. Disney is doing really poorly right now. They're down 25%. Um, their park makes up, or their parks make up 28% of their revenue, and since they've been closed, obviously it's going to give a huge impact to the company. Um, Amazon, on the other hand, is up 25%, which makes sense. People are still, needing uh, products and using their services. Uh, and they've had some trouble keeping up with demand, but overall, I think they're hiring a lot more workers and trying to keep up with the demand out there. Dish Network has done very poorly. They're down 62%, but that's the company we decided to focus on. So I will let Drew give his analysis on that. Some other companies, Stone Co. down 46%, not doing well. That's part of our tech sector. Procter and Gamble, let's see, they're not doing too badly, but General Motors, they're doing very badly. People aren't, out and about buying cars and stuff like that these days, so that makes sense. Activision is up 9%. Makes sense. People are playing video games more than ever because everyone's stuck at home. Tesla's doing well, up 34%. They went down all the way to $361 per share in the middle of March, but since they have recovered and they're all the way up to $751 a share. General Mills, they're doing very well, 13% up, and that makes sense because, we're all stocking up on food and continuing to use their products.
Hey everyone, this is Drew. The company our group is going to be focusing on today is Dish Network. You may know Dish Network as simply a satellite TV provider, but as you'll soon find out, they're actually invested in a few other industries as well. So, in the satellite TV service industry, Dish Network's top competitors include DirecTV, Sky, Liberty Global, and Comcast. So, like I said earlier, their corporate strategy originally was solely based upon being a pay TV provider. But over time, their priorities have slowly changed and they've diversified their business plan as they now include wireless network service and a TV streaming service. They are heavily invested into 5G infrastructure and they currently have a plan to cover 20% of the country by June of 2022, and that percentage goes up to 70% by June of 2023. So, specifically with their 5G network, they have contracts with the US government, which hold the company liable for the deadlines I just mentioned, or else they face a penalty of up to $2.2 billion. Lastly, Dish is diversifying their business with their recent addition of a streaming network, Sling TV. And although this network has over 2.4 million subscribers, these numbers don't hold up to the more recent launch of Disney Plus, as they've already reached 10 million subscribers. And coming back around to their planned 5G network, many big analysts have begun to lower their price target of Dish Network stock, as you probably saw in Luke's presentation a little bit earlier, as they now are starting to raise the price targets into T-Mobile's network.
Hi everyone, this is Kevin, and I'm going to be reporting on a couple key financial ratios for Dish Network and how these ratios have changed over the past 5 years. The first ratio I will cover is current ratio. Current ratio, also referred to as working capital, is a liquidity ratio that measures a company's ability to pay short-term debt. Current ratio is calculated as current assets over current liabilities. This means that a current ratio less than 1 indicates that a company cannot fully cover its short-term obligations with its most liquid assets. Looking at Dish Network's current ratio, we can see that it has been below 1 for 4 of the past 5 years, but has been trending upward since 2017. Comcast, a major competitor of Dish, has had similar current ratios over the same period of time, also seeing a slow increase over the past 5 years. The second ratio I will cover is return on equity, or ROE. ROE measures the return on net assets and how effectively management is using the company's assets to create profits. ROE is calculated as net income over average shareholders' equity. Many investors compare the ROE of a given company to the long-term average ROE of the S&P 500, which is 14%. Anything around this level is considered acceptable, and anything less than 10% is generally considered poor. Looking at Dish Network's ROE, we can see that there has been a steady decline from a stellar 33.62% in 2016 to a subpar 12.91% in 2019. On the other hand, Comcast saw a sharp increase during 2017, sandwiched between 4 years of slow and steady growth.
Hi, this is Wilson. I'll be covering financial ratio aspect with Kevin. So we've looked at Dish's and its competitors' Comcast profit margin, debt to equity ratio, and also cash to debt ratio. Dish Network has a net profit margin of 10.93%, debt to equity ratio of 1.23, and cash to debt ratio of 0.2. From these ratios derived from the company's 10K, we can assume that the profit margin of Dish Network is lower than its competitor Comcast at 11.12%. This means that Comcast is able to yield more profit from their revenue each financial quarter than Dish Network. However, Dish Network for the past 5 years has been keeping their debt to equity ratio at relatively low rates. This means that the company is not leveraging too much debt. In addition, Dish Network has a higher percentage for cash to debt ratio than its competitor Comcast, which also signifies that Dish is actually in a stronger financial position than Comcast currently, and is able to more securely pay up its debt with cash in hand.